Ladies and gentlemen, good day, and welcome to the Q3 FY23 earnings conference call of Apar Industries Limited. As a reminder, all participant lines will be in the list, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ambesh Tiwari from Essential Technologies. Thank you, and over to you, sir.
Hi, good afternoon, everyone. This is Ambesh Tiwari from Essential Technologies. I welcome you all to the third quarter FY earnings call for Apar Industries. To discuss the business performance and outlook, we have from the management side Mr. Kushal Desai, Chairman and Managing Director, Mr. Chaitanya Desai, Managing Director, and the CFO, Mr. Ramesh Iyer. I would now pass on to Mr. Kushal Desai. Thank you, and over to you, sir.
Thank you, Ambesh. Good afternoon, everyone, and welcome to Apar Industries Q3 earnings call. Let me start by giving an overview of our performance and follow that up with a short industry update. I would then like to get into more details on the segmental performance of the three businesses. And post that, we can open up the floor to questions. So during Q3 FY23, the consolidated revenue came in at 3,942 crores, which is 77% higher than the previous year. This was largely driven by volume growth across all divisions. Our export revenue grew by 144% year on year and is today contributing 49% of the overall company's revenues. This is compared to 35% a year ago. The EBITDA is also up by 174% year on year to 349 crores at an EBITDA margin percentage of approximately 8.8%. Profit after tax for the quarter came in at 170 crores, which is 210% higher than the previous year. It is at 4.3% versus 2.5% in the year ago period. 9-month consolidated revenue stands at 10,270 crores, which is 63% higher than a year ago. And our export revenues have grown by 105% for the 9-month period. In terms of some of the key industry highlights, India's power consumption logged a double-digit growth of over 11% to 121.19 billion units in December 22 compared to a year ago. The robust growth of the power consumption indicates sustained momentum of economic activities through December. The peak power demand met, which is the highest supply in a day, rose to 205.03 gigawatts in December 22, while the figures for the previous year at the same period were 183.24 gigawatts, and it was 182.78 gigawatts in December. Power deficit in the country rose slightly to 0.6% in the April-November period. India's power consumption logged a high of 9.6% to 343 billion units in Q3 FY23 compared to a year ago. So these are all robust growth indicators and a clear sustained momentum in the economic activities that are a reflection of the amount of power consumption that the country is observing. The central government, as most of you may already know, has announced a very ambitious RDSS scheme, largely around improving power distribution of approximately 3 lakh crores. Of this, about 30% is allocated towards spend is approximately allocated towards cables and conductors. It will largely be cables and to a smaller extent conductors. This spending is expected to be deployed in a period of approximately 5 years. Also, the total outstanding dues owed by the electricity distribution companies to power producers, that is to generation companies, has nearly halved to 675 billion as of December 22 compared to 1210 billion as of December 21. This can be attributed largely to the various steps taken by the government, such as implementation of late payment surcharge rules and provision of a facility for equated monthly installments to utilities. So if this trend continues, then it is a good sign of more discipline coming in terms of the distribution sector, which so far has been the Achilles heel of the entire power infrastructure of the country. I would now like to specifically talk about the business highlights by each segment. Our conductor business revenues in Q3 FY23 grew by 103% year-on-year to reach 1,912 crores for the quarter, with a volume growth of about 99%. The export revenues grew by 288% year-on-year, contributing to 53% of the division's overall revenues. The premium products in our basket of conductors contributed towards 44% of the revenue mix. The EBITDA per metric ton post forex adjustments came in at 49,942 per ton, which is a historic high. The conductor division has seen a transformational journey in the past decade, and I think today we are reaping the fruits of all those investments and decisions that have been taken and invested in during the past several years. The improvement in the EBITDA is mainly due to the higher share of premium products, the higher share of exports in the conventional conductors, where our realization is better than in the domestic markets. There have also been a couple of strong tailwinds where we've seen the price of steel having reduced, as well as the container freight costs having come down to most destinations at the pre-COVID level. During the 9-month revenues, they came in at 4,899 crores, so they are up 81% year-on-year. Volumes are up 51% year-on-year. The EBITDA per metric ton for the period came in at 37,900, which is 125% higher than the previous year. Our current order book stands at 4,885 crores, with 44% of that share coming from premium products. So overall, our conductor division has had a very good quarter, and in fact it's the best quarter that it's had in its all-time history. Coming to the oil division, there the situation has been a little bit more difficult. In Q3 FY23, revenues came in at 1,245 crores, which is up 38% year-on-year. Volumes have grown by 9% in the quarter, backed by growth in the transformer oil business, both domestically as well as overseas. Exports contributed towards 43% of revenues. EBITDA post forex adjustment came in at 1,646 rupees per KL, and this is in line with the guidance which was given earlier, where there was a clear expectation of lower profitability given certain inventory corrections and price corrections which were expected. The lubricant revenues came in at 238 crores with a volume of 17,063 KL. Looking at the 9-month period, the oil division revenues are up 33% year-on-year at 3,489 crores. The volumes grew by 3% in the 9-month period. EBITDA post forex came in at INR 5,190 per KL. Looking at the cable division, in the third quarter of FY23, revenues grew by 89% year-on-year to reach 921 crores. There were significant increases coming from the sale of our elastomeric products as well as exports. Our exports contributed towards 49% of the overall sales in Q3 versus 35% a year ago. The elastomeric cable revenues are up 29% year-on-year. We continue to see a robust business in the renewables energy space, both domestically as well as overseas. So EBITDA post Forex for the quarter came in at 109 crores, which is 11.8% of revenues, compared to 8.7% a year ago. Looking at the 9-month period for cables, revenues are up 77% year on year at 2,320 crores. And again, the elastomeric business and the export business is what has contributed to the growth. The overall export business is around 52% of sales in the 9-month period. The EBITDA post Forex is at 9.8% for the 9-month period compared to 4.4% the previous year. Our business is expected to hit the target which we had mentioned in our guidance of 3,000 crores revenue for this segment. So overall, we continue to be quite optimistic about the growth prospects of the company. All the key growth parameters seem intact. We are well placed to tap into the benefits of power infra-led spends both domestically and overseas in key markets like the United States, Australia, Europe and Latin America, especially as there is this push towards renewable energy, as well as the China Plus One benefit or opportunity for India continues. I would also like to mention that we have an updated corporate presentation with significantly more details on the company profile and performance, which has already been uploaded on our website. And specifically, I'd like to highlight that it carries more information not only on customer mix, but also on receivables and receivables funding that we have for the business. So with this, I'd like to come to the end of my comments. I appreciate the time all of you have taken out for joining this call. And I can open up the floor to questions now, please.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Mahesh Bindre from LIC Mutual Fund. Please go ahead.
Hi, thank you so much for the opportunity. Sir, there is a dramatic improvement at EBITDA per ton for this quarter. So we are hitting around 49,000 now. Last year we were anywhere between 15 to 20,000. So why this improvement has happened?
Yes, so as we explained in the opening remarks, the conductor division has seen this transformation journey, and the high margin is actually the result of two things. One is that the share of premium products is going up, which gives us a higher margin. And secondly, even on the non-premium products, the proportions of our overseas businesses has increased. Both has resulted in higher margin. And also we have seen some tailwinds in the form of steel prices as well as freight, which has come down since the last 1 year, which has increased this margin to about 49,000 per metric ton.
So if you strip aside the benefit of steel prices and the trade cost, transportation costs, so what will be the sustainable EBITDA per ton could see going forward?
So, in the short term, which is for the next couple quarters, you will still see EBITDA per ton, which is relatively high, in the 30,000 kind of range. But, we've given a guidance that, sustainably, if you take a longer period of time, just with the structural changes that have happened due to the premium products, we are looking at, we've given a guidance of 22,000 to 24,000. As these premium products are growing, the EBITDA per ton will continue to edge upwards. See, one fundamental mix which has which has changed. So, Ramesh here has already given you that 44% of the revenues have come from premium products. But when you look at the balance, 56% of the revenues, a large portion of that is actually conventional conductors which has gone overseas, as opposed to have been sold in the domestic market, where we have been seeing better realizations. The domestic market, still realizations are quite poor because the standards itself expected from many of the EPC players are laid at a very low level. Whereas, as you go into the more developed markets, which I mentioned in my opening comments, which are countries like the United States, Europe, Australia, Latin America, the standards expected are much higher from suppliers. So we look at the market on a global basis. Wherever we see the best netbacks in terms of profitability, then we focus on servicing those contracts. So in the current situation, we are seeing good opportunities in these overseas markets for standard products, and we are focusing on the domestic market largely for the premium value-added products. So that mix is what is helping, drive this. Of course, the tailwinds, as Ramesh mentioned, there are two specific tailwinds which are there, which is that from the time that some of these prices were quoted, steel prices have moved down, and some of the contracts are DDP contracts. We saw the brutal side of it, last couple of years, but in the last 2 quarters, these freight rates have been coming down, so we've been seeing now the benefit of that. So I hope that kind of holistically answers your question.
Thank you, sir. We have the next question from the line of Amit Anwani from Prabhudas Lilladher. Please go ahead.
Hi, sir. First of all, congratulations for the great set of numbers. So first question for the conductors business. Just wanted to understand in more detail, you mentioned that the non-premium products are seeing higher exports, and HEC, we are largely focusing on increasing the volumes in domestic market. So any color on 2-3 key geographies where you're seeing the higher traction for standard products, or any 2-3 geographies where you're seeing higher traction for HEC products? Some color on that sense, how the market is accepting your products in conductors business, and which markets are accepting it.
So I'm not sure whether we understood your question exactly, but see, the order inflow for high efficiency conductors and the copper products and all continue in the domestic market. And as I mentioned earlier, 44% of our 4,800 crore order book, 4,885 crore order book is these products. But the standard products which are there, which are standard conductors, we have been increasingly getting opportunities to supply overseas, where the profitability is better than in the domestic market. So that's the mix that we are.
Yes, my question was, like you said, standard products. Just wanted to understand the major 2-3 geographies where the standard product.
So as I mentioned earlier, the United States is the largest market, and following that, is Australia and some markets which are in Latin America.
So can we assume like these are contributing more than half of the exports for standard products?
Yeah, absolutely.
Okay. So my question for cables, are we still sticking to 20-25% CAGR for next 2 years in that? And second thing is, you mentioned the electromeric cables contribution is going up. So if you can just highlight how much percentage it contributed in this quarter.
Yes, so we continue our guidance about 25 to 30% on the cable business, as we have been talking earlier also. And sorry, what was the next question on?
Elastomeric growth.
Contribution in the quarter.
Yeah, so the total growth is coming from our HT cables, LT cables, as well as elastomeric cables, and it's a combination of domestic as well as exports. What has happened in the cable business is that our share of exports has gone up considerably. So if you look at the Q3, we are close to about 50% in terms of exports, which was just about 35% last year. So this share of exports has gone up, which is what has resulted in the growth of this cable business.
Right.
Also, there is a growth which we are seeing. It's a smaller growth, but a growth has also come from our what we call light duty cables and the business which is a distribution based business. So we started off, one first year we had 20 crores and 60 crores, and last year was 100. This year we should be close to 200. And the following year we are targeting 350 crores in that segment. So that business is also growing parallelly with exports. And then you asked for the growth on what is driving the growth on the elastomeric side.
Right.
So that growth is being driven by the renewables energy space, the expansion happening there.
Domestic?
So we were, until 2 quarters ago, the business was all purely domestic. But now we have some of the increased capacities which I had spoken about even in previous quarters for cables that go into both windmill as well as solar. And so now the export of those products has also started.
Right.
So you will see actually as we get into FY24, more and more export of these renewable cables also happening. Cables going to renewable energy space.
And this elastomeric is higher margin business?
Yeah, the elastomeric cables are very specialized cables, and therefore they carry a higher margin. We are also one of the few vertically integrated players where we make our own, we do our own insulation, the polymers that are used for insulation. So we do our own formulation and mixing of those.
Right. So my last question on RDSS scheme, which you mentioned in your opening remarks, and you highlighted that 30% might be allocated to cables and conductors over 5 years, which gives me about 18,000 to 20,000 each year. So if you could just highlight on the addressable market for Apar and how much Apar as an entity can grab out of this pie.
So theoretically, we have products that cater to the entire basket of what is required. So these are, low voltage and medium voltage cables. It's a combination of underground cables and overhead cables / conductors. So, we are in a position to actually address all of these requirements which are there from a product standpoint. Now, it all depends then finally in terms of, who the counterparty is and what are the terms and conditions. But my main point of bringing this up is that there is going to be a good growth in the requirement of cables both domestically as well as export.
Right.
And usually when they say 5 years, it may still another year or two, but the market is going to expand because of this RDSS in addition to whatever else is already there, in terms of market segments. So therefore, the overall bullishness on the cable side is also quite high.
Right. So last, if I may squeeze in, can we assume that we are seeing a sustainable high growth? We will continue to see sustainable high growth in exports markets, at least in near term, across cable, conductors and cables?
Yeah, absolutely. We expect the current momentum, on the export side to continue not only for the next quarter, but also whatever we can foresee in FY24 as of now. And, as you may be knowing that even in the United States, the infrastructure bill and all is already on its way, to get approved and executed. So the benefits of some of that have still not come in. This is pre the infrastructure bill spend actually taking place. And on the renewable side, as more assets are coming up, it requires not only cabling at the site and then evacuation to the grid, but then the grid is basically a conductor grid that then evacuates the power into, whatever is the grid in that particular country through which distribution to customers takes place. So in short, there may be ups and downs in terms of quarters, but if you look at the trend over the next 3 to 5 years, the trend is very positive because globally power infrastructure is being added.
Thank you very much, sir. All the best.
Thank you. The next question is from the line of Gopal Agarwal from HDFC Mutual Fund. Please go ahead.
Good afternoon, sir. Actually, congratulations for great sets of numbers.
Thank you, Gopal. Could you just speak up a little bit because your voice is a little soft.
Sure. So just wanted to understand the two segments have done well. So general, what's the outlook on the lubricant? Because generally this quarter impacted by inventory and forex. So how do you see the trajectory? Thank you.
Yeah, can you just repeat? Your voice was very low.
Sorry to interrupt, sir.
Yeah.
Mr. Agarwal, I would request you to use your handset to ask a question at this time.
Yeah. Hello.
Yes, please proceed.
Yeah. So just wanted to understand your outlook on the lubricant business because generally this quarter had a negative impact of currency and inventory. So how's the trajectory on this side?
So yeah, on the lubricant, meaning, let me address it, specialty oil and lubricant, the two separately. In the case of the specialty oil side, which is your transformer oils, white oils, etc., the transformer oil volumes have been reasonably good, both domestically as well as export. We've had a bit of a cost pressure which is there. Part of it has come basically from base oils having fallen at a very rapid pace. Some of it is due to the lack of purchase from China, which is the largest importer of base oils in the world. All of us know the recent quarter problems which they've had, and that has continued into January of this year. Because of COVID spreading and many establishments and factories not running fully normally. So as a consequence, there was a big drop that took place in spot availability, meaning pricing of spot cargoes of various base oils. Also, the public sector refineries had a lot of surplus base oil for two reasons. One is the overall demand of lubricants has been a bit soft. Especially the retail side has been a little bit on the soft side, and I guess this resulted in an untimely or unplanned increase in base oil inventory which the public sector oil companies had. In addition to that, they've also had record production of base oils compared to previous periods. This put together resulted in them having excess product. Base oils is a very tricky item to store because you can only store it in specific tanks of specific quantity. So if the volume is getting produced faster than evacuate, the only option is to crash the price so that people end up buying it. And that's precisely what happened. We were expecting a little bit of that to happen, but what actually ended up happening was much more brutal than had been envisaged. Now, as we go into Q4, that situation is getting normalized. And my sense is that by the end of this year, that's by March, the situation should come basically closer to normal, because I don't think fire sales will continue. There is also an industry view that Chinese demand may come out stronger, and that's the reason why none of the refineries around the world have actually cut production.
Sure.
So it seems like a bit of a short-term problem. And by the end of the year, I think you should start seeing more normal economics. Lube companies which keep very low inventory of base oils and they buy on a just-in-time basis, obviously they have benefited because they could take advantage of these spot prices. Companies like us run 70% of our purchase on longer-term contracts. And therefore, it's taken longer for the tail to get cleaned out in terms of the inventory.
Got it, sir. Really appreciate, and really very happy to see the volume growth and profitability. And just wanted to understand your focus on B2C side on the cable business, because your cable quality is quite good. How do we penetrate market? Just your strategy on that. Thank you.
So on the B2C side of the cable business, we've taken a strategy of wanting to build that on a step-by-step basis. I mentioned earlier that from revenue of approximately 100 crores that we did last year, we'll be at close to 200 crores this year. And we have a target of hitting 350 crores in FY24. So that is largely coming. Our products are very well received there of the best quality that's there in the country by a margin. The key is actually adding distribution. And so we've been going about that. We today have distribution in the 5 southern states. We've added Uttar Pradesh. We've also added West Bengal and Bihar. So, the rollout is happening. And our expectation is that, this will slowly increase, on a step-by-step basis. If there are some basic numbers you'd like, if you look at March 22, we had about 20 distributors. As we hit December 22, we are close to 100 distributors. If you take our presence in retail counters, we were at 275 retail counters in March. We are at about 1550 retail counters at the end of December. So, that spread is increasing. And our product, the way we sell the product is by conducting demonstrations to electricians and specifiers. So, we were at around 6,000 demos per quarter, in the March quarter. We've increased to 25,000 demos, in the September-December quarter. So, all of these is all grassroots level. For example, to take electrician meets, we were at about 450 meets in the March quarter. We are at about 2,500 meets in the December quarter. So, it's we want to grow this on a grassroots level basis with good distribution. So, you will see every year about 150 crores getting added in this segment year on year.
Great, sir. Thank you very much. Thank you.
Thank you. The next question is from the line of Charanjit Singh from DSP Mutual Funds. Please go ahead.
Hello, sir. First of all, congratulations on great set of numbers. So, my first question is regarding the exports market. So, while these markets are pretty large and our opportunity size is pretty strong, from the growth perspective in the export segment, how we can see from the next 2 to 3 years perspective, and do you see the overall mix of export versus domestic increasing further going forward in next 2 years time frame? That's my first question.
Yeah, so in terms of overall growth, we expect that the domestic market will grow because of RDSS as well as industry growth and just general GDP growth. The good thing about wires and cables is that any establishment that's built requires some wire and cable just because of the electricity that needs to be distributed. So the domestic side, you will definitely see growth. That growth will allow us to do a little bit of cherry picking in terms of who we want to service on the domestic side. Our sense is that the export markets for us, export sales will grow faster than domestic. We've actually invested a lot of money in approvals. For example, the United States requires what is called an underwriter's laboratory approval, UL approval. So we have the highest number of UL approvals in the addressable segments out of all the Indian manufacturers, as of today. We are still working on more approvals. We've now penetrated the European market for cables that go into solar and wind. We already supply a fair amount of cables into Australia, for example, that cover solar, wind, and there's a big expansion happening on metros, underground metros and the train lines. So we've been a major supplier to the Sydney Metro. Now we are bidding on all the other metros over there. So the overseas business, I think, will also continue, and my sense is the overseas business will grow at a faster pace than the domestic business.
Got it, sir. So the other thing is you talked about a lot of these distribution reforms and what we are also seeing on the ground, reconductoring. If you can touch upon that aspect, how these distribution reforms can, add to the overall growth for the conductors business and even for our transformer oil business.
Yeah, so as far as distribution reforms are concerned, it is much more cable intensive than conductor intensive. So you will see the cable business being able to address a large portion of that opportunity. There are a certain class of conductors called medium voltage covered conductors, where you really make a conductor and then you provide an insulation on it. So it's actually produced by our cable division, even though the alloys and conductors were originally designed by our conductor division. But the finished product is sold by our cable division. So largely this will be addressed by the cable division. In terms of transformer oil, you will have more and more distribution transformers going in, and you will also end up having some amount of power transformers which will bring in power to the grid, and then from that substation connect into the next level of distribution. So transformer oil ka demand will be kind of linear with the with the number of transformers which are being supplied. And most of these transformers, almost all of these transformers under RDSS will be oil-filled transformers. Excuse me.
Got it, sir. So last question from my side is on telecom and convergence business. We have seen, some ramp up from your side with new business head. So how is that opportunity shaping up? Maybe it may not be, in 1 year time frame, but in a longer term, do you think that will getting bigger for us?
It is definitely getting bigger. We've created a separate team within the company with a separate business leader and who's working across the synergy of the divisions that we have focused on this. So there, we have OPGW, which is a big play for us, and you'll see within the conductor division more and more of this OPGW, turnkey work which we are doing. In addition to that, the 5G rollout will give a lot of impetus to not only the fiber optic side, but also the copper side and hybrid products. And so this 5G rollout is going to happen in India, but has already started happening in the United States and in some of the overseas markets. So we have a set of products which are addressing this. We are in the process of getting a whole series of products which are under approval from some of the big players in these overseas markets. So you will see this particular vertical also growing over a period of time, and it's pretty much going to be new growth that's there. I mean, even though it involves conductors and cables, but it's a different vertical, and you're addressing a different market segment, which is basically telecommunication and 5G infrastructure.
Got it, sir. So thanks a lot for taking my questions. All the best for the future. Thank you.
All right. Thank you.
Thank you. The next question is from the line of Chirag Setalvad from HDFC Mutual Fund. Please go ahead.
So congratulations on a fantastic result. Just a few questions in terms of profitability. You mentioned on the conductor front that improvement in mix, steel prices and lower freight all contributed. I missed those numbers. So I know third quarter profitability came in at 40,000 rupees a ton. What do you think is a sustainable level in the near future, and what do you think is a sustainable level in the long term? You mentioned it, but I missed those numbers.
Yeah. So in the short term, this momentum can continue. Of course, the exact number will depend on the exact kind of products that we execute, also depending on how much orders that we get during the period. But we expect in the short term it could be in the range of about 30,000 per metric ton. But on a sustainable basis, we clearly see it to be in the range of about 20 to 24,000 per metric ton.
And so what would cause it to drop? Is it the mix that will change? How much of this 40,000 can be attributed to the steel prices and lower freight?
So the way maybe to say is that it really depends on your macro and the geopolitical situation prevailing. So currently these situations are all favoring us, and if this kind of situation favors us, possibly we could see this high momentum going forward. But we are able to give a visibility depending on what we can clearly see as of now. And
Chirag, to sharpen the sort of numbers or the view here. See, if you see what has been the transformation in terms of the margin per ton is that the domestic business of South Asia, which is India, Nepal, Bangladesh, all this has seen a lot of high efficiency conductor supplies, as well as copper and the premium products. And that's contributing towards about 44% of the revenue. The balance 56% today is largely going towards exports at good realizations into fairly developed markets like the United States, Australia, and to some extent Latin America. So the realizations that are possible there and the kind of competitive intensity is very different compared to the domestic Indian market, because the expectations on the customer are significantly higher. So this mix is what has given that boost. If this mix continues, you will be in the 30,000 range. But if things start getting fully normalized, there's also some China plus one advantage which we have. So if some of these things disappear, then you will still be at, just because of the product mix that is available today, you will still be in that 24,000-25,000 rupees per ton range, simply because you are selling higher value added products. So if you were to model it over the short term, you will be in the 30,000 odd range. If you model it over a longer period of time, 24,000-25,000 rupees a ton can be taken as a base number. And then whatever favorable situations are there will be a top up on that.
Perfect. That's very helpful. And similarly, in the cables business, where do you see sustainable profitability?
So cable business, if you see in the last few quarters, our margins have gradually increased, and this quarter we had 11.8% as EBITDA. We see that on a long-term basis, a double digit of 10% would be sustainable, with the product mix improving, with our geography mix improving, and also getting high economies of scale. At this point of time, we are maintaining the guidance of about 10% on the cable business.
Perfect. Great. Thank you very much and all the best.
Yeah. Okay.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Management. Please go ahead.
Yeah, hi. Thanks for giving the opportunity, and congratulations on a great set of numbers. Sir, largely I wanted to understand around the premium conductor side. I mean, given the fact the premium conductor percentage is going up, and even exports is getting incremental focus, which is leading to higher profitability. So I just wanted to understand, isn't the competition putting a focus over here, given the fact that this part of the business is turning out to be a big profitability business? So how do you see competition largely from Indian players over looking at exports and even the local players in these geographies? So if you could throw some light around that, are there any incremental capacities which are coming up from competition, or is there some movement around that? That was my first question. Second question on the copper prices. I mean, off late around the month, we have seen copper prices going up by 10%. So how do we see that impacting our profitability on the recent run-up which has happened on the copper prices? And my third question was on the US infra side. I mean, given the incremental focus which will come on the US infra bill, so what is our strategy here? What is our on-ground people they have that will put? What is the GTM strategy, and what kind of business are we possibly looking at over the next 2 to 3 years, specifically from the US infra bill side of the things here?
So I'll take the first question first. The competitive advantage, as you mentioned on the conductor division, if you look at this, our updated presentation, we have a separate slide that talks about our competitive advantage on conductor, cable, and oil division. But just to talk about it, what we feel is that our products, which are premium products as well as conventional products, we have some competitive advantage as compared to the competition. Basically, in terms of technology and the know-how that is involved in this product and design, which actually acts as a barrier to entry for the competition. And it involves a special stringing mechanism, as well as there is a lot to do with the design of the product, which is something that cannot be easily copied. And it's just not a product supply, but it's the entire turnkey solution that is what we give for some of the premium products, which actually acts as a barrier to competition over there. Also, in terms of conventional products in the export, if you see a lot of requirements that a customer demands is not only the product, but also in terms of reliability, quality, and also in terms of the risk management exercise. So they look at the holistic things instead of only looking at the product and the pricing there. And based on the years of experience that we have in this business, we are at a very advantageous position when it comes to supplying these products in the overseas market. Could you repeat your second question? I just missed out.
Yeah, sure. So my second question was on the copper prices. I mean, off late we have seen copper prices going up by 10% in the last month. So how would that impact our profitability? And if you could throw some light on what is our hedging strategy, how do we hedge it? So some color around that.
So the copper price, there won't be any impact, because the entire B2B side, we hedge the product on a back-to-back basis. The moment we have orders, we hedge, not just like we were running the hedging strategy on aluminum, we run a similar hedging strategy on copper. So you won't see any major impact due to the move in the copper prices as such.
The prices, high or low, are getting passed on to the customer. So we are.
In many cases, it's actually fixed because the order has come at a fixed price, and the metal has been booked back to back on that. So for example, all the deliveries which you do for solar cables, windmill cables, for your defense, for the railways, we follow the same strategy. Where the moment the order comes, the forward cover is taken, or the forward booking is taken, and the metal is hedged. Where you are open is to some extent on the wire and cable side through the distribution network. But there we've seen all the major players, they increase and decrease prices on a very regular basis, and their stakes are much higher. So we are just a follower in terms of those changes which happen. So the polycabs, Havels, KEIs, and RR cables are the ones which move the price up and down based on copper movement, and so we will just follow based on the same proportions.
Sure.
So we don't see major impact on the copper.
Sure, sir. Yeah, got it. Yeah. And my third question was on the US infra side.
Sorry, it was on?
Yeah, the third question was on the US infra side. I mean, given the fact that US has come out with its infra bill.
On the US infra side, the fundamental growth is coming from, three areas. Number one, cable requirements which are going into the installations of solar farms and wind farms. Second is evacuation that's happening from that into the grid, which is where the conductor comes into the play. And the third piece is the actual strengthening of or replacement of old transmission networks which are there. So we are in a position to actually participate in all these three.
Sure, yeah, understood, sure. And just lastly, an extension to the earlier question which was there on the premium conductor side. So are you seeing competition putting up capacity for the premium conductor space? I mean, is industry putting up incremental capacity on that offering?
So we have competitors who are also adding some capacity on that. But here it's just not a question of adding capacity like in the conventional conductors, because most of these are part of a solution that's provided. So there's a design element of the conductor involved, there is a design element of the network that's involved when you do the reconductoring, and then there is also stringing technology which needs to be in place. So as a turnkey operator, we actually have the most advantageous position because we have all these three elements with us. We have the product, we have the design of the network, and we have the ability to string and deliver the reconductoring or new conductoring projects involving these special products.
Sure, sir. So that's it from my side. Yeah, thank you very much, and best of luck for the future. Yeah, thank you.
Thank you. The next question is from the line of Maulik Patel from Equirus Securities. Please go ahead.
Thanks for the opportunity and fantastic set of numbers. I think what we were discussing earlier, I think it's finally taking place for the conductor segment, and good to see that you are still having the confidence that this business will continue to grow. A couple of questions, I think more on the balance sheet side and on the capex side. What's the acceptance as in Q3 FY23?
So our interest-bearing acceptance is about 3,400 crore as of December end.
Okay, and the debt will be other than that the normal debt, working capital debt?
So we have a long-term portion of the debt about 200 crores, and the current maturities of long-term debt is about 50 crores.
Okay, got it. And what kind of capex this year we are spending more on the cable side and not on the other businesses? So how much we have spent and what's the outlook for the next year?
So the capex spend over the next 15 months, we expect to spend close to about 300 and odd crores between the cable division, which is the lion's share of it, and the conductor division. There will be very little capex on the oil side. And our plan is that not only do we want to put in capex to meet the current growth, but now look at ensuring that we have some excess capacity or surplus capacity in place a little bit earlier than the demand comes in and hits. Because as we are going around the world and getting approvals, and more projects are getting approved, we continue to see the growth taking place. So, it's more prudent, we believe, to actually put the capacity a little bit ahead of time. So we've looked at a new greenfield site for cables.
Sure.
In conductors, we've acquired some land right adjacent to one of our plants near the Silvassa area, and machineries are going in there. So about 300 odd crores over the next 15 months is what we expect the capex to be in. That should help, keep the momentum going in terms of growth, both for cables and conductors.
Sure. And out of the 300 crore, large part I assume that it will spend over the next 12 months, right?
Yeah, the whole thing will go in the next 15 months.
Sure.
What's happening today is that the reason why the number looks a little higher and the period also is about 15 months is that if you place an order for equipment today, the equipment delivery times have substantially gone up, whether it is because of manpower or it's because of electronics, and many critical components for these still come in from overseas markets like Europe and the United States. So delivery times have gone up substantially. So that's why if we want to make sure we don't miss opportunities, we need to invest a little bit ahead of the curve.
Sure, I got it. Yeah. Thanks.
Thank you.
Thank you.
The next question is from the line of Vivek Gautam from GS Investments. Please go ahead.
Congratulations on an excellent set of numbers. So, few question is about the due to Ukraine crisis and now China opening up after 3 years of COVID, it is now, instead of the China plus one policy prevailing, has been told that exports to Europe and US are suffering because China is able to supply at a competitive price. So how come we are getting so good performance in exports? And secondly, is there a transformer oil shortage in India leading to high prices? Even black marketing, I have been told that of transformer oil, and which is helping us a lot.
Let me address the two questions separately. So in terms of the China plus one, I think it's it's a very strategic decision that many utilities and countries have taken. So it's not related to COVID being there for the last 3 months and COVID going away. So we have seen customers who have taken undertakings from us that not a single component that goes into whatever we supply to that country will have a product coming in from Russia or China, for example. So I don't think this China plus one is something in our industry at least that is going away in a hurry. It's here to stay, and Indian companies actually like us stand to gain because it's part of a strategic vision that buyers are having. As far as the second question, there is no shortage of transformer oil. We can deliver any quantity of transformer oil. There is no black marketing of transformer oil happening. So I don't know where this has come from, but there is no shortage, in short. There is no shortage of transformer oil either in India or anywhere in the world at this stage. The growth which we have seen has largely been in volume because we've been able to address, we are approved pretty much everywhere wherever the demand is taking place. But on the contrary, because the raw material costs have fallen very sharply, as I mentioned earlier, people like us who work on longer term contracts have been hit in the short term because we've had to adjust our prices lower than what the supply chain reduction would have normally allowed us. And that will start reversing, the trend will start reversing in this quarter, probably normalize in the first quarter of next financial year.
And so how is the opportunity science and what CAGR we can grow, and how sustainable has been the good performance over the last 2 quarters, sir?
So in terms of sustainability, especially in cables and conductors, cables especially, we can see a 25-30% growth to come for the next several years. In terms of conductors, we've seen growth at least for the next 2 to 3 years. You will continue to see a good momentum as all these transmission networks continue to be built. So this is not a short-term phenomenon. I think it's a big structural play And depending upon how much infrastructure is replaced in countries like the US, you have to keep in mind that a lot of infrastructure there went in between 1945 and 1970, before that big oil shock took place. So as that infrastructure gets replaced, so far people have been somehow or the other pulling on, but there is a finite life that all these products have. They're designed to last for 30 to 35 years. Already many places they've lasted for over 50 years. So they'll finally give way. So depending on that, you will start seeing, conductor demand growing. But if you exclude any major, just a steady growth, you will see at least for the next 2-3 years, clear visibility is available.
And how has been the B2C performance and branding, and how are we getting the response under Sonu Sood's brand ambassador?
So our B2C response has been good. I've actually thrown up very specific numbers against one of the earlier questions. But bottom line is that the business has grown. Last year was about 100 crores. This year we will be at about 200 crores. Next year we are targeting 350 crores.
Okay, sir. Thank you, sir.
Yeah.
Thank you. The next follow-up question is from the line of Amit Anwani from Prabhudas Lilladher. Please go ahead.
Hi, sir. Just a couple of questions on any targeted debt level which we are looking in the medium term. And I can see interest cost and finance charges at 225 crore for 9 months, significantly higher than the last 2 full years. So any elaboration on that? How should we model the interest cost in coming quarters?
So I think the SOFR rates have actually increased over the last 7-8 months. And if you see every quarter our interest cost is going up. In terms of the rate increase, almost Q3 would be maxed out unless any further rate increase are there. And also it's a function of improvement in the business. If you see the business is growing, so you will see the interest cost also going up in line with the volumes there. But these will all be taken into consideration when we price our products to the customers, because we take the recent exchange rate and the recent interest rate at the time when we price to our customers. So you will see an increase in EBITDA as well as you will see an increase in finance cost as our volumes and interest rate goes up. But Q3 could be a good approximate at this level of business.
So on a unit basis, I think you're already at nearing the max, depending on whatever the FOMC meeting results are. And the number of days for modeling purposes, the number of, the structure of the receivables, inventory, etc. is reasonably steady. So that is what can be used. In terms of long-term debt, we have the balance sheet has a capacity to borrow. We have 250 crores of long-term debt. 50 crores will get repaid in this quarter. So we intend to take some borrowings for the 300 odd crores of expansion. That's in place so that the retained earnings are available for working capital requirements, etc. But for modeling purposes, you can take the current NODs, number of days for each of these, and they should be reasonably representative of what will happen in the days to come.
Got it, sir. Thank you.
Thank you. The next question is from the line of Himanshu Upadhyay from O3 Capital. Please go ahead.
Yeah, hi. Congrats on good set of numbers. My question would be on capital allocation. Okay. So from here on, we have already stated that 350 crores is going for capex. Okay. Can you elaborate how much capacity will increase through this 350 crores of capex?
So, the ratio for most of these is, 1:4, 1:5 in terms of, the amount of product that can come out. Plus, part of this is, a whole greenfield site which will be 40 plus acres of land, so that there's room to then keep adding machinery, as the business continues to grow. So the key thing here is to look at, what will be the return on return on equity that you're able to maintain, through this period. So we are already close to about 18.5% to 20%. I think if you take the 9 months, it's at actually 21%. But our idea is to not allow the ROE to drop substantially, and most of these projects have reasonably good payback, because the market is already there, and most of the market development activities have already been done. So as you ramp up the production, we are already working on customers and channels to be in place.
Okay. See, if I break or return on equity now, so there are three sides, okay? Revenue to gross block, which has been always very good for the company. The revenue to working capital, which has been generally on the higher side, and EBITDA margins on conductors, where we have already seen a lot of work which has gone, and improvements are, I think, visible, and cables also. Is there some scope to improve EBITDA margins on the transformer oil sustainably, or not just the transformer oil, the oils business, okay? And with economies of scale, which is coming, because is there something we can do on to improve working capital further on? Means what can be the bigger driver of sustainable ROE for you from here on in the working capital side and the EBITDA margin side?
So let me specifically address the specialty oil segment. So the specialty oil segment, we are not seeing any spectacular growth. Growth will be there 5%, 7%. In transformer oil, the growth may be higher than that as transformer capacities get added, both in India as well as overseas. But you've got white oil and some of these other segments where you may see even lubricants, particularly automotive lubricants, as electric vehicles start getting rolled out, the growth on some of that may slow down. But where the company's real growth is going to come is on the cable and conductor side, where you can clearly see a lot of infrastructure getting added. Now, in terms of the working capital, there is a slide in the deck which gives you an idea in terms of secured receivables that we have. Because wherever we end up giving extended credit to customers, it's usually backed by a letter of credit on the other side. So you may end up getting payables for some of your raw materials, which is extended, but on the other hand, you also have a whole lot of letters of credit or secured payments on the receivable side. So both payables and debtors are both, we are working on both sides of it.
And one thing.
And in case there are interest costs associated with the extended credit days, they are factored into the pricing of the product. The customer usually has a certain number of days interest free, and then they add the interest for the extended days of credit.
And one more thing. Generally, our dividend payouts have been between 20 to 30%, okay? And with higher growth rate, what we are visualizing, do you think the dividend payout ratios will remain the same, or do you think more cash will be required for the...
Which our board has to decide. But as of now, the ratio that we have is between 25 and 30%. And given if there is continued growth taking place, then I think we probably would still remain in the same range, having a bias towards reinvesting back. Because as I mentioned earlier, we don't see this growth as being a short term, and this market momentum not being short term. There is a clear opportunity for a company like us to grow not only domestically but overseas. And it does require the right investments to be made, and those investments, if made correctly, will have a good payback.
And the growth what we are expecting is in those segments, return on equity and capital employed would be upwards of 20%. So that is what we are trying to get. Because commoditized business you can get any time. Even in the down cycle, whenever it will happen.
ROE is in that range. I mean, it's taken a lot of effort to get it to the 20% mark. Every time you have a capital block going on, you can have a short-term drop, because it takes a few quarters to ramp up the production and realize the full volumes. But I think we are at a momentum today where it is possible to be in that 18-20% range, through all these expansions, etc. There is a clear economy of scale available both in the cable and conductor business. So, as the volumes go up, there is a conversion efficiency which will clearly kick in.
See, my question was this, that the segments where we are seeing growth because of currently because of high demand, it can be a good ROE, but even in the commoditized business, sometimes the ROEs can be high because of demand supply. But our focus remains on high margin or high ROC businesses only for growth also. That should remain that on track.
Yeah, so I don't think you'll see a big change in the mix of what we've got. The target or the idea would be to keep improving the mix, i.e. which is, more value-added products or premium products, and then where there are standard products moving to more premium buyers.
Okay. And in Europe also, are we seeing
one fundamental thing, so it'll put it in perspective. You see, when you go when you supply to Indian buyers, they really go essentially on a two-bid process. So once you clear a technical specification, then it becomes only price. So if you're 41 on 100 or 99 on 100, you're almost equated. Whereas when you go into the overseas market, that 41 on 100 itself is in the 70s. So the bar itself is much, much higher in terms of what they classify as pass or fail. So that's where, I say that you're looking at premium products, and for standard products, you're looking at more premium buyers.
And one last thing. See, we are speaking about the US, okay, where a lot of growth is visible, okay. So what is your sense on Europe? Because a lot of other capital good companies on the power side are extremely optimistic on the Europe because of waste to heat and so many, means the energy transition which is happening and the business growth which is happening. What is your exposure and what are you seeing?
In Europe, we are also seeing demand in place. We've been successful in starting to supply cables, particularly into the non-conventional energy space, which is both largely solar and also some amount of wind. So our expectation is, as I mentioned earlier, that Europe is one of the target markets which we have.
Okay.
Yeah. And with the current issues that they have on both power and manpower in Europe, it bodes well for India. Recently, there was an industry meeting that our Commerce Minister, Shri Piyush Goyal, had with the top exporters of the country. And in terms of laying out what is expected over the next few years, there is also, they already have a free trade agreement in place now with Australia. They've put an agreement in place with the UAE. There's a free trade agreement under negotiation with the EU. So if that happens, then Indian products have 3.8 to 4% custom duty, which if that comes off, then that makes us that much more competitive.
Okay. Thank you and best of luck for the future.
Yeah, thank you.
Thank you. The next question is from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Hi, sir. Thank you so much for taking my question and congratulations on a great set of numbers. So, I'm a bit new to the company, so pardon me for some basic questions. So, as you said, our EBITDA margin in the conductor businesses, which are at around 40,000, they will come down to 30,000. So, could you just help me with how would that work? So, we would see a decline in our EBITDA margins.
So, what we feel is that depending on the order book that we get, the margins could change. We've got some tailwinds in this particular period, but definitely the profitable product mix has changed, and that's the reason you see higher EBITDA margin on the conductor division. Now, how exactly these orders will get executed, that will depend at the end of Q4. But what we are saying is that if you want to build a model for a long period of time, or 2 years, 3 years, we don't know how the macroeconomic and geopolitical things will pan out in future. And from that perspective, we feel that, a conservative estimate of about 24,000-25,000 per metric ton would be there in the model. That's what we intended to say. But definitely in the short term, we expect good order and profitability continuing in the near future.
Okay, sir. And in terms of our revenue growth, what can we expect next year? What is our any target that we have that we want to reach that number or something, that could help me?
So the cable business, we are talking about 25 to 30%. In our conductor business, you should see at least 15% to 20% growth, between this year and the coming year. The oil business will be closer to about 5 to 7%.
Oh, okay, so that helps a lot. So, and with regards to the fluctuation in finance costs, I understand correctly that we pass it on in our EBITDA, and that's why we have a higher finance cost. So, as revenue increases, our finance cost will be a similar figure, will be dependent on that, or is that?
As I mentioned earlier, if you take the number of days for outstanding inventory, all the components that contribute towards the business model is reasonably set. So we don't expect any major change to be there, in that. So really the movement will be up and down depending on where the interest rates are. So I guess in the shorter term you'll have higher interest rates. When inflation and things come off, then maybe the interest rates will also start coming off.
Okay.
But we are factoring into our business that higher interest rates are being taken into account as part of the costing.
Okay. So that helps. And our new capex, so what kind of an asset turn can we expect from it?
So on the cable side, you have, depending on the product, anywhere between 4 to 6 times. If you go to house wires, then it can be as high as about 8 to 10 times. And in conductors also, it's around 5 to 6 times, depending on the nature of the product.
Okay, sir. And if I may squeeze in one more question, so what would be our capacity utilization currently?
So currently on most of the cable and conductor products, we are running pretty much flat out. And that's the reason why, this capex is being incurred. And more equipments are coming in, to support the growth.
Okay, sir. Thank you so much for your time and all the best for the next quarter.
Thank you.
Thank you. Our next question is from the line of CA Garvit Goyal from Invest Research. Please go ahead.
Hello. Good evening, sir. Am I audible?
Yes, good evening.
Okay. So my question is from EPS side. In last conversation for Q2 Concall, you were mentioning that the overall EPS will be half two EPS will be in line with the half one EPS. But now for the 9 months it is 103. So where do you see the EPS laying out for entire FY23, sir?
So we have given an overall guidance. If you build that model, we'll be able to know how much will be the EPS. Specifically, we can't comment on exactly what could be the number in the next quarter, but based on the division top line and bottom line profitability, you will be able to work out the EPS, how it will pan out. Because each of the divisions have different growth rates, so you have to put that math to see how the EPS will move going forward.
Because you are saying conductor business will grow 15-20%, oil 5-7, and cable 25-30. So this seems to be a little bit conservative, considering your first 9 months growth. And one side you were also saying that this high growth momentum will continue. So that's why it is a little bit confusing regarding the growth guidance.
Yeah, so we're looking at the long-term guidance. That's what, if you want to put that in a model, those are the guidance numbers that you need to build into that.
So if you look at FY23, you can pretty much extrapolate, whatever are in the first 9 months. The first 9 months, you can carry it forward into the fourth quarter. If you are looking specifically at what is expected in this financial year.
Basically, you're saying 9 months. This 9 month section will continue in this.
Here's a slide which is given in the new deck that addresses, what the current structure is. EPS by each business is indicated also.
So kind of momentum we witnessed in 9 months, we can expect it in next 1 to 2 quarters, you are saying?
For the next quarter, I mean, you're talking about this current quarter, the average that you see over the first 9 months will continue that's the visibility which we have as of today.
Okay, understood. Okay. That's all from my side, sir. All the best.
Thank you. The next question is from the line of Yogesh Bhatia from Sequent Investments. Please go ahead.
Hi. Congratulations, sir, on very good set of numbers.
Thank you.
Yeah. Sir, I wanted to know that do you think the worst in the base oil business is behind us? What we saw in Q3, high cost inventory, etc. Do you think it is behind us?
Yeah, at least in the current situation, I think the worst is behind us. Really.
Okay. Yeah, that's it, sir. Thank you.
Thank you. The next question is from the line of Saurabh Patwa from Quest Investment Advisors. Please go ahead.
Thank you, sir, for taking the question. Am I audible clearly?
Sir,
Yes,
yes, sir. Please proceed.
Sir, congratulations on a great set of numbers. So I think a lot of my questions have already been answered. Just 2, 3 things. One, on the conductor side, for a very long time, we used to give a guidance of around sustainable margins of around 12 to 14,000 basis of higher margins in HEC, which used to be around 25, 26,000. So, is there any possibility of going back to that situation?
No, I don't think we'll go back to that 12 to 14,000 because if you also look at the product mix that existed in that 12 to 14,000 period, it was largely A, conventional conductors, and B, it was being largely sold in the domestic market, which is very competitive.
Fair enough.
So right now there is a structural in terms of the mix of product, and at least as I have been saying over the last hour, we see more premium buyers coming forth to buy standard conductors.
Right. And do we need to make any adjustment to the plants to have a higher share of these products?
No, we made our manufacturing fungible. So as a consequence, as the more premium products need to come on board, we already have capacity on the aluminum side. On the copper side, we've been making adjustments and additions, as the copper side is being, the capacity has been going up. In terms of quality or premiumness of the products which we can produce, that has always been built into our system. So I think we're just getting more premium buyers who have a much higher standard of what they require. Especially when you go overseas, the minimum bar for passing is significantly higher than in the domestic market. Domestic market, anything that conducts a current is good enough for you guys.
True, sir. In the past, you used to highlight that since there have been not a lot of conducting happen in US and other North American markets, and that's why the competition, there won't be any actually lot of players left there. So now when you see that opportunity actually arising there, is the same true now as well, or some Chinese player or other players have started getting into that business?
No, so I think that's holding true that local manufacturing there, is not able to keep pace, and I don't think we see investments going in for new capacity to be added at any huge appreciable pace in North America, Europe, any of these places, because they're fundamentally not so cost competitive, in terms of the operating costs over there. In terms of this Chinese player, we don't expect anything sudden to happen because many of these buyers are actually quite strategic in their purchase, and they've laid down quite clearly their policies. I mean, we'd be surprised if it changes dramatically from what they've laid it out to be.
Great, sir. And just one last question, if I add, is the capacity which we are adding in conductor side, I believe you mentioned it's in Gujarat, but I believe in the Odisha where we have another conductor plant, we have some arrangement where we could get liquid metal model. So, any specific reason to do this capex in Gujarat?
So the capacity for rods that we are adding is being added in Odisha.
Okay.
But the conductor making capacity we are adding in Silvassa. Simply because, if you see a higher and higher percentage of export taking place, we are today exporting from both the Silvassa plants as well as the Odisha plants. And export logistics out of Odisha are not the best. Whereas we are getting more and more options for export out of Silvassa, because you have the ICD Tumb, which has now been taken over by Adani Logistics. They are increasing capacity there. There are more ports coming up in and around Gujarat. So Silvassa is a very good location for manufacturing for export.
Understood. And on oil side, how's our Maria plant doing? Had plans of bulk exports from there.
The Hamria plant has been doing quite well. In fact, their volumes have been consistently growing. They are at almost 18% above the same period previous year for this particular quarter. The Middle East has been doing better because of the current oil prices, etc. And they're able to weather the whole energy situation also better. So our expectation is that growth from that plant will continue to come, especially on the transformer oil side. The white oil, etc., is in trouble because the three largest countries that buy in Africa don't have foreign exchange, which is Egypt, Nigeria, and Ethiopia. But the transformer oil side is coming from the more industrialized countries, and you have the whole GCC, you have Latin America, Europe, everywhere. Power conductors going in, distribution conductors, transformers going in. So the transformer oil side seems quite good.
Thanks a lot, sir, and all the best.
Okay, thank you.
Thank you. The next question is from the line of Dhavan Shah from AlphaCurate Advisors. Please go ahead.
Yeah, thanks, sir, for the opportunity. So I have a question on the conductor side. In this slide, you mentioned the revenue mix between exports and premium products. So would it be possible to share the volume mix between exports and premium out of the overall 44,500 tons for this quarter?
So you see, if you take premium products are 44%, and if you take exports, that is also almost 50% of it. So the amount of standard conductors sold in the domestic market is very, very low.
Volume-wise, it will be the same? The revenue mix will be the same?
It's difficult to tell you volume because there are so many different types of products, shapes and sizes. Okay. So basically, I think the value mix will give you an idea of what's happening. And in fact, that's been one of the major reasons why the profitability has also been a bit higher.
Okay. In terms of the EBITDA per ton, can you please share the differentiation between the exports and premium products against, the 49,900 rupees a ton, what we have done?
I think we don't want to go down to such a granular level because along with you, we have competitors who are also looking for that information. Okay. So I think, to the extent that's possible for us to give information, I think we've already displayed it.
Okay. And suppose, I think you also mentioned that some input inflation and the lower freight cost, which has helped to improve the EBITDA per ton. So if you exclude these two things, then what could be your EBITDA per ton against the 49,900?
We put a base case of 24 to 25,000 per metric ton. And then we've also given what could be tailwinds which are there, which is i.e. standard products export continues at a higher pace, and that is an adder. If steel prices remain steady, then that helps. So our expectation is that in the long term, in the short term, we'll be around in the 30,000s in terms of value addition. In terms of longer period, you can take 24 to 25,000 per ton.
Okay.
So that forms like a base number, going forward.
So against the base number, would it be fair to assume that the premium product EBITDA per ton would be roughly 1.5 to 2x against the base business?
So depending on the product, we've classified a basket of products. So if you look at that range of products, then it is, compared to typical, if you compare it to domestic conductors that we sell, it's at least 2x of that. In terms of the overseas conductors, it's it's somewhere in between.
Got it.
And the order to order, country to country, etc. So that's why we've tried to simplify it by giving a EBITDA per ton, considering a certain product mix.
Right. So this premium products is entirely for the domestic market, right? 44%.
Yeah, largely going into India, Bangladesh, Nepal, mostly because it's being done largely on a turnkey basis.
Right. And what is our overall market share in this segment, premium product?
So on the premium, depending upon, of course, so if you look at the copper products, we may be in the 15-20% range. The railways, we are much higher. We are about 40-50%. And if you look at HEC, high efficiency conductors, etc., we would be at least 40%, 40-45% market share. Because it's dominated currently by Apar and Sterlite Power. There are obviously, over a period of time, more players will come in. But so far, we've been able to hold a fairly good market share.
Got it, sir. Thank you.
Thank you.
Yeah.
The next question is from the line of Bobby Jairam from Falcon Investments. Please go ahead.
Yeah, hello. Do you do EHV cables?
We don't do EHV cables. We basically go up to 66 kV. So that's actually considered as medium voltage or in some cases high voltage, but not extra high voltage.
Any plans to get into that?
Not at the moment, because the products which we have at the moment, where we have the approvals, we have the expertise in place, we see a fairly large addressable market there. And our current focus is to address extra high voltage situations by medium voltage covered conductors or by conductors.
Okay, got it. And the other thing, you said that the U.S. is a major market for exports, right? But I was wondering, these countries have a lot of local procurement rules. So how is this going to impact your They all want it locally manufactured, right, ideally. So how is that going to impact your export trajectory?
So I don't see any emphasis on local manufacturing coming from, for example, the United States, because there just isn't enough local manufacturing. And if you the unit cost of production there relative to a place like India, it's much cheaper to produce here and ship. There is some pressure in terms of having availability of stocks. So we do have many large distributors who buy and stock our products and then resell them to utilities there. We've also been looking at setting up a manufacturing facility at some point, which is nearer to the United States, to service the US, Latin America, etc. So you can then, once you have a site there, then you can have some production going from there and then also production coming in from India. But at the moment, for whatever our immediate plans are, we can easily service them from our plants in India. Because you see, a lot of the project sites which are there, they don't need overnight delivery. They have a planned project delivery schedule. So when a solar plant is being built or a wind farm is being built, there is time available, to manufacture and deliver the product to the site within the window that the customer defines.
Right. No, that's perfect, because I thought the Inflation Reduction Act specifically asked for products to be locally manufactured.
So right now it's not hurting us. We are examining manufacturing in geographies like, Mexico, Colombia, these sort of places, where Mexico, of course, has an advantage because it falls under NAFTA and it's considered, as a local manufacturer. But most of these cases, just the physical availability of product itself, is not there, and the cost of manufacturing there is relatively very high compared to what would happen over here.
Okay, got it. Right. Thank you very much.
Yeah.
Thank you. As that was the last question for today, I would now like to hand the conference over to Mr. Kushal Desai for closing comments. Over to you, sir.
Yeah. Thank you very much for being on this earnings call. Just in conclusion, I'd like to say that the opportunities that we see in our business will present itself, not only in the short term but also in the medium term. And we will continue to remain focused on the products and markets which we have established ourselves in, because we see good growth coming in, from those areas. And with that, our objective and aim would be to continue to sustain, a good momentum as we go forward. So thank you very much for being on this call, and look forward to interacting with you all in the future. Thank you.
Thank you, sir. On behalf of Apar Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your